Today we're going to talk about trickle-down economics, so hit that subscribe button and turn on that notification bell so you stay educated on how your money works. To understand trickle-down economics, we have to iterate some economic basics. First off, all capitalistic economies undergo natural ups and downs. In times of prosperity, economic activity is high and jobs are easy to find. In times of recession, a country's economy produces less and people have trouble finding jobs. Government steps in to try to help smooth out these fluctuations and dull the pain of sharp economic downturns. In a nutshell, trickle-down economics is based on the premise that within an economy, giving tax breaks to the top earners makes them more likely to earn more. Top earners invest that extra money in productive economic activities or spend more of their time at the high-paying trade they do best, whether that be creating innovations or performing heart surgeries. Either way, these activities will be productive, reinvigorate the economic growth, and in the end generate more tax revenue from those earners and the people they helped. According to the theory, this boost in growth will ultimately help those in lower income tax brackets. Although trickle-down economics is often associated with the policies of Ronald Reagan in the 1980s, the theory dates back to the 1920s. The name also has roots in the 20s when humorist Will Rogers coined the term, saying the money was all appropriated from the top in the hopes it would trickle down to the needy. Rogers' comment cemented negative associations with the theory for several generations to come. Proponents of the logic behind the theory object to calling it trickle-down and argue that the name is inherently misleading. So let's talk about boosting the economy, supply versus demand. Why anyone would give huge tax breaks to the wealthy eludes many people. Some would argue that because the rich have used the freedoms of an economy to make much more money than they need, they should give back a larger share than those who are struggling. This is the very idea behind the progressive income tax in the US. When income reaches higher brackets, the government taxes that excess at a higher rate. But under the logic of trickle-down economics, tax breaks for the wealthy benefit everyone. To understand the reasoning behind this, let's take a look at the history of the idea and the basic principles of supply and demand. In an economic slump, some say the government should make efforts to increase the supply, output, or production of an economy. Others argue the opposite. Lack of consumer demand is the root of the problem, and government should encourage consumer demand. 19th century French economist Jean-Baptiste Say argued the former. Say's law states that the way to economic growth is to boost production and demand naturally follows. This flew in the face of the belief at the time, which was that a lack of money and lack of demand caused bad economic times. Say asserted that there will always be a demand for the right kind of products. You can think of it this way. If there are people willing to work during a recession, they obviously want money in order to consume something. They must already have a demand that is not being met. What they demand is either too expensive for them to afford or is not being produced. Producing in-demand products and driving down costs will create profit for the seller, and thus the means for him to satisfy his or her demand. Hence, production greases the wheels of the economy. This logic makes sense to major thinkers of the time, including Thomas Jefferson and James Madison. A century later, the tide had been turned in the US. By the time the Great Depression hit in the 1930s, many legislatures held the opposite view. The most notable opponent to Say's law during this time was John Maynard Keynes, a British economist. Keynes argued that there are such things as overproduction and lack of demand, and the key is to increase demand rather than supply. Government should promote consumer demand rather than entrepreneurial production. When people consume more, they create more jobs and production. Arguing that in the long run we are all dead, Keynes pushed for short-term fixes for immediate economic stability. He encouraged governments to adjust monetary policies and fiscal policies to boost demand. Part of these adjustments include increasing taxes on the rich and reducing taxes on the poor. While the rich would invest their money on making more products, the poor would be more likely to spend, consuming the oversupply that was the source of the problem. Keynesian economics continued as the predominant philosophy in the US for decades to come. By the 1970s, trickle-down ideas were percolating in the minds of some economists who sought to return to Say's principles. So let's talk about Laffer's curve and the logic behind trickle-down economics. Why do trickle-down economists think that taxing the wealthy less leads to an increase in production? That can be explained in terms of tax revenue. Some argue that giving tax breaks to the wealthy can actually increase tax revenue for a government. This might seem difficult to believe, but Arthur Laffer argued otherwise. Working off ideas posed by the 17th century Muslim philosopher Ibn Khaldun and John Maynard Keynes, Laffer concluded that government tax rates and revenues don't have a directly positive correlation. In what became known as the Laffer curve, Laffer showed that the relationship between taxes and revenues looks like a curve rather than a straight line. In other words, tax revenues don't rise consistently like tax rates do. Laffer's curve shows that when tax rates are at zero, revenues are zero as well. The government makes no money when it taxes nothing. But it's the same result if the tax rate were 100%. Think about what would happen if the government demanded every cent in your paycheck. Why work? Or why tell the government what you're making? The government would bring in no money because there'd be no incentive to work or to report earnings. So tax revenues are zero when the tax rates are at 0 and 100%. Most agree with that. The question is, what does it look like between these extremes? The Laffer curve postulates that once the rates get too high, the steep taxes discourage work to an extent that the revenue themselves suffer. Take another scenario. By June, you've already made $1 million, and the progressive income tax promises to tax that income 50%. However, anything you make over $1 million will be taxed 90%. Why work the rest of the year when you know you can only keep 10% of your income? You'd probably take your $500,000, retire to your beach house until next year. At this point, the taxes are discouraging work and tax revenue. The range in which taxes are too high for a maximum revenue is called the prohibitive range. When taxes are in this prohibitive range, a tax cut would produce an increase in tax revenue, according to Laffer. But the ideal tax isn't necessarily 50%, rather it depends on the taxpayer. Through Laffer's curve, we can visualize how tax rates could discourage people from producing, which results in fewer jobs and a hurting economy. On the flip side, lowering taxes at the right time can reverse these effects. Laffer points to examples in US history where lowering tax rates increased not only government revenue, but also the GDP growth and lowered the unemployment rate. Jude Winniski built on Laffer's idea and argued for a return to ideas centered around Say's law, in other words, increasing production. If Laffer's curve is correct, then cutting taxes for the wealthy can encourage investment and production to promote general economic health. Boosting the supply side of the economy rather than the demand side is the way to economic prosperity. Winniski also makes clear that cutting the high taxes on the wealthy will encourage more economic activity and growth for all. This was redubbed supply-side economics, which supporters find less polarizing name. Trickle-Down Economics found a new life in the US in the 1980s. So then let's talk about the basics of Trickle-Down Economics. So now that you have an idea of the origins of Trickle-Down Economics, let's try to put all these pieces together to understand Trickle-Down Economics as a whole. According to Say's law, boosting production is the key to crawling out of a recession. Tax breaks improve tax revenue, and according to Laffer's curve, they also boost production. Giving tax breaks to the wealthy stands as a policy meant to improve the overall health of the economy. Opponents of this economic theory tend to believe that the politicians who support it are at the pockets of wealthy businessmen. They often summarize trickle-down economics as something resembling Will Rogers' definition, the policy of giving breaks to the rich first and hoping the benefits will eventually make their way to the working classes. Proponents of trickle-down or supply-side economics object to this evaluation, calling it not just an oversimplification, but a misinterpretation of the idea. Thomas Sowell, an ardent supporter of trickle-down economics, argued that the popular definition gets it backwards. Instead of benefiting the wealthy first, the policy actually benefits the working class first. This may sound impossible after all, it's the wealthy who get the tax breaks, not the poor. However, Sowell maintains that because the wealthy make investments in order to make a profit, they spend the money first on expenses of the business venture, in other words, spending money to make money. These wealthy investors must pay workers, thus creating jobs, before they can expect to make any profits. Therefore, it's the workers who receive the most immediate relief. While it might be true that some wealthy members of society seek tax breaks for self-serving purposes and might even bribe politicians with voting for their policies, trickle-down economists would consider this irrelevant to the question of whether the theory works for anyone. JFK showed his support of trickle-down economics when he said a rising tide lifts all boats, meaning that a growing economy benefits you whether you're rich or poor. So then let's finally talk about the implementation of trickle-down economics. Although some characterize trickle-down economics as an experiment originating in the 1980s under Ronald Reagan, the US had actually used it before. The Harding, Coolidge, and Kennedy administrations implemented supply-side tax policies before Reagan did. The first instance of supply-side economics being implemented came even before the trickle-down idea was fully articulated. After World War I, top income tax rates had risen from a modest 7% to 77% to help pay for the war. This high rate would fall into the prohibitive range of the Laffer curve, according to the theory. The Harding and Coolidge administrations passed a series of tax cuts to reduce wealthy citizens' tax burden, which had ballooned. Although opponents argue that this kind of policy contributed to the Great Depression, Arthur Laffer points to the resulting increase in tax revenue, GDP, and employment as evidence that the tax cuts worked by boosting production. But this policy soon faced sharp criticism. When the stock market crashed in 1929 and the US economy sank into the Great Depression, the idea of giving tax breaks to the wealthy was an unpopular policy. People blamed Herbert Hoover, who'd shown support for the tax policies of his predecessors. In 1932, voters replaced him with Franklin Roosevelt, who promised a New Deal that would help the economy from the bottom up. A Keynesian economics took hold. Wealthy members of society who'd enjoyed the low marginal tax rates in the 1920s would see a dramatic reversal in the next 20 years. During the Great Depression and World War II, the top marginal rate rose to more than 90%. Entered John F. Kennedy, who was sympathetic to the idea behind supply-side economics. He argued that lowering taxes increased tax revenue, creates jobs, and increases profits. His tax cuts didn't pass until after he was assassinated, but Laffer argues that they had the positive effect on the economy that Kennedy had hoped for. Others say that the cuts hurt the gross national product (GNP) growth and resulted in rising unemployment. Until Ronald Reagan was elected president, no other administration in the US championed supply-side policies. In the late 1970s, economists like Laffer and Jude Wanniski were touting the advantages of increasing production through tax breaks for the wealthy. What they said convinced many people and fit into Reagan's economic philosophy. In 1981, Reagan passed his Economic Recovery Tax Act, which cut all marginal tax rates dramatically. The top fell from 70% to 50%. Since then, trickle-down theory has been tied closely to Reagan's policy, collectively known as Reaganomics. So trickle-down economics remains highly controversial. George W. Bush faced harsh criticism for his tax cuts. Despite staunch political opponents to trickle-down policies, some maintain that the general consensus among economists today is that the theory works. So what are your thoughts? Do you agree or disagree with trickle-down economics? Leave a comment down below and let's get a discussion started. And as always, take care of your money. Today's book of the day is Dare to Lead by Brene Brown. I'll leave a link to the book down below, and if you prefer listening to it on an audiobook for free, I'll also leave a link to a 30-day free trial to Audible. You can choose this book or any book to listen to, and even if you cancel before your free trial is over, you can still keep the book and listen to it whenever you want.